bringing in Andrew Holland, CEO at Avendus Capital Alternate Strategies. He's joining us on the show right now. Andrew, thanks very much for taking out the time. How are we set up right now, according to you, as we move into 2019? We've been receiving a whole host of data points, not just domestic, but global as well, where we are looking at some amount of economic pressures building up across the board, which could ultimately have its own bearing on the equity markets. For ourselves, we had inflation numbers coming out yesterday, which seemed to be coming in at 18-month lows. How is the setup looking macro-wise, and then how would you look at the equity markets?
Well, macro-wise, globally, it's not looking great at all. I mean, if I look at the data from the US, whether it's auto sales, new home sales, existing home sales, mortgage applications are all plunging. You saw the data yesterday from China. Industrial production from Europe was terrible. So, and we got the Brexit vote today. So it's like a race to the bottom at the moment. Who's going to get to recession first? But my feel is that the US is probably heading there, or is there already. It's just not showing through in some of the data. But some of the underlying data that I mentioned is quite scary. So I think we're in for a growth shock. Most people are saying that they don't expect a recession this year, but the Fed's increased rates, that's going to start hurting corporate earnings, and you could see a very quick slowdown, particularly if there's more prolonged negotiations on the trade front with China. So the optimists will say, well, that trade deal will get done quickly, but it doesn't change things overnight. So it's still going to be the slowdown's happening, and it's happening very quickly, and you're seeing that across many data points. And in particular, worrying is Germany and Europe. So the macro doesn't look great for India. Obviously, the inflation figures were well within the kind of the ranges that the RBI look at. So when they meet in February, I think 25 is baked in already. It's whether they go for 50 in terms of a rate cut, because they can do that. They should have done it last time around, looking at the data. So in that respect, the RBI could give the economy an extra little fillip, towards the kind of elections.
Okay. Andrew, good morning. Neeraj here. The results season hasn't quite started off with a bang. If anything, each of the larger companies that have come out with numbers thus far have a chink in the armor or two, or maybe more. Are you kind of bracing yourself for maybe lower than estimated Q3 as well? Or do you think this time around, while the start hasn't been the great, we could actually see a much better performance as the season rolls on?
I think it's going to be okay. I mean, it's not going to be, some of the companies, obviously industries, will be affected by the higher oil price in the first part of the quarter. But I think this quarter will also see that the benefits of the lower oil price. So, it's a little bit of mix and match in terms of the sectors. But overall, I think earnings is still going to be anywhere between 10 to 15% growth for this year. So I'm not particularly worried. That's well within our kind of expectations. I think the problem is that, again, we started the year with most expectations being that 20 to 25%, which was never going to be met. So there's where the disappointment is. But I think it's going to be okay. Okay.
Let's certainly hope for that. What's also been in the thick of action, Andrew, the last few days has been IT. Now, primarily, yes, because of the two numbers that have come out and how contrarian the outlook seemed to be, and then the Wipro bonus announcement notwithstanding. But brokerages now, by and large, are coming out and downgrading their estimates. Morgan Stanley was a case in point today. A smaller one, Nirmal Bang, did it about 15 days back. A couple of others informally have said that even though IT stocks have corrected quite a bit, they're not quite seeing them bounce back with the same fervor as they have done in the past. What is your stance here? Are you buying into the, not distress really, but the correction that we've seen, or are you staying out?
See, I think you need to look at IT in the shorter term. And what you're seeing at the moment is people's expectations just again being kind of taken away from the more rosy picture that they had. And obviously trying to building, maybe a bit of a slowdown that's happening globally. One of the things that I do expect this year is that the dollar will weaken, and that will play on sentiment in the very short term negatively obviously for the IT stocks. But if I'm correct that the race to the bottom in terms of who hits recession first, then they're going to be seen as safety stocks as well. So whilst the growth might be not as rosy as people were expecting, it's still going to be growth nonetheless. So I think there'll be a place to hide in. It's probably just not there yet, but it will be, and that's probably why you're seeing the stocks hold up reasonably well, despite the kind of strength in the currency recently.
Right, Andrew, with earnings expected to come in terms of single-digit growth, what is going to justify the heavy valuations that India is currently trading at of 17 times? I mean, we're still higher than our 10-year average in terms of our PE multiples as well. Valuations, while have come off, they're still at the higher end, with the earnings support not yet coming in full gusto.
Yeah, see, I think you've got to look at it relatively to elsewhere, and if the world is going to slow down considerably, then obviously a lot of the emerging markets, which are exporters, are going to feel the pain even more than India. So it's all relative. If India is growing at 7.5% GDP growth and earnings are anywhere between 10 to 15% growth, which we expect, then that's going to be seen as one of the better performing in terms of both earnings. So you're going to pay a premium for that in a globally kind of challenged economy and earnings. So we're just at the beginning of this. And don't forget that India itself was one of the better performing markets last year. So whilst it's underperforming at the moment, that's it's nothing to be surprised about. There are cheaper markets out there. But I think once we start to see some of this turmoil unfold in terms of global economy, then India will be seen as a safe haven. And I think that's what you've got to think about. And don't forget that when you look at what's the drivers of our index, it's going to be your FMCG, your private banks, which are all highly rated companies, and rightly so. So that's what's keeping the ratings high. I think below the index, valuations are looking a lot more interesting.
What is the expectation in terms of whether or not this time around you will see laggards picking up pace, or is it going to remain in terms of the interest with the larger cap names? I'm talking about a comparison between mid caps versus large caps, and whether they will see more interest in mid caps this year, so considering last year was a bad year.
I think it's going to be maybe a case of two halves. I think it's going to be large cap led, at least for the for the next 6 months, and then after elections, working on the basis that it's a reasonably stable government, and then you will see that private capex pick up in the second half of the year, into the second half of this year, into 2020, and I think that's what will then our focus will be more towards the kind of mid caps and small caps at that stage, as the economy gets an extra boost. So it's an area which I think is going to still be difficult for the next 6 months because of the volatility I'm expecting both globally and locally. So mid caps and small caps I think will be avoided by most investors, and really just see what I think is going to happen is I think there's a developed market problem in terms of the global kind of economic outlook, and that will throw you opportunities in our markets, because we'll get hit along with every other market, and that's where you're going to find the opportunities in some of the large caps. And I think if you can keep your powder dry and wait for some of those opportunities, you're going to get plenty of them in the next 3 months.
Andrew, just wondering there is not a rule out here, but just wondering what's the quantum of cash that you reckon you could be sitting on, if not now, then maybe 1 month, 1.5 months down the line? Would it be higher than average?
No, I think we'll look to see what we need to do. Markets have quietened down from their kind of December, kind of turmoil globally as well. So I said, I think what we're going to do is look to see those opportunities, and we're going to be, provided plenty of them to pick up individual stocks. So I think the index is not going to be your right barometer. I think it's going to be the underlying sectors and companies, which is going to be where you're going to make some money. And I think the private banking space is very interesting at the moment. I think Access Bank seem to be making quite a lot of heavyweight appointments, which is bolstering their management team. And I'm sure that whoever takes over at Yes Bank might well do the same. So you're seeing a lot of changes in the banking space at the moment, which are more positive. And again, I think that will help lead the banking index higher going forward.
Fair call. Andrew, we'll leave it in that. Thanks so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time.